Hi there, and welcome to Tuesday's Commodities Corner with me, Darren McDermott. Well, today I'm joined by Bart Melek, Head of Global Commodity Strategy at TD Securities in Toronto. So Bart, the price of US WTI crude futures, which lifted briefly above North Sea Brent crude yesterday, actually fell back today on short-term profit-taking. Can you tell us more about what we are currently witnessing with WTI and Brent crude?
At least for the next little while, we expect crude to be at elevated levels. The key catalyst for us is the ongoing instability in the Middle East, in Egypt in particular. I think the concerns about flows through the Suez will be a factor. And I think U.S. demand should improve moving into the summer, and that is very much a seasonal type of a development in response to holiday driving season in the United States, and for that matter, in much of the Western world. So we see prices well supported for those two reasons.
And Bart, what is your outlook and what will be the driving factors?
Well, we expect WTI to move down a little bit. We expect it to average about $95 a barrel by Q4 of 2013, and we expect Brent to be about $105. The key reason is right now, as I said, there is a bit of a premium because of geopolitical developments, particularly in the Middle East. We think that the market will end up accepting this, or it's not going to get any more priced in, and we would think that certainly globally there is no tightness in the supply-demand fundamentals, and at this point we think the market has overshot based on what the inventory levels are and what the supply-demand relationships are likely to be. Let's not forget, we don't see China picking up as much as people thought earlier in the year. There'll be steady growth, about 7.5%, unlikely to be 8%. Europe continues to underperform, and we think the U.S. will do well, but that's not going to be enough to upset the supply-demand balance. So we think prices trend a little lower, particularly if there is a bit of geopolitical stability. So too high for the fundamentals.
And Iran has suffered due to Western sanctions on oil. However, Iran has just secured a $15 billion deal to supply gas to Iraq. What does this deal mean for Iran and for the energy sector?
To a great extent, it means the same thing as it means in North America, where we're seeing natural gas being increasingly used in everything from transportation to power generation. But that's more of a longer-term type of a phenomenon. It'll take time to absorb that supply and new demand. I think the impact immediately in that part of the world isn't likely going to be great. We're going to have to essentially come and wait and see to how this supply is absorbed. I think on the margin there might be some expectations that it could crowd out some demand or some uses for oil, but I think any material structural change will take a while. So probably globally, very little impact.
And finally, what else should we be keeping an eye out for within the energy sector?
Well, certainly geopolitics is going to play a very important part. We've always had that, and I think this time around will be no exception. The conclusion is this. If we see things stabilize in the region broadly, ranging from Syria all the way to Egypt, then we should see some downside pressure on oil. If things escalate or become more unstable, then of course there is upside pressure. And on the demand side, we are probably steady as she goes, given that China is not performing as well as we thought just a little while ago. We are unlikely to get huge increases in demand, so we're not going to get as much help from Asia as we had previously. So the Asian economies is something that we have to look at to gauge where prices are going, and of course, extremely important, what the Federal Reserve, the U.S. Central Bank, does and how the American economy is performing. Of course, the United States is still the world's biggest user of oil and energy broadly, and what happens in the economy there will very much determine where the global economy is going and oil demand. And the central bank policy will drive the currency very much. And a stronger dollar implies some downward pressure on crude, and a weaker dollar the reverse. Our view is that the U.S. dollar should be fortified over time, as we expect the U.S. Federal Reserve to tighten monetary policy over time amid a recovering U.S. economy. So two forces. One force, better demand working to move oil higher, and monetary policy driving it down. Ultimately, we think in the absence of a weaker China, the monetary policy dominates over the next 6 months.
Thank you very much, Bart, for that, and thank you for tuning in to Dukascopy TV. Make sure you have a look at all our interviews and press reviews, but for now, goodbye.